All right, let's talk about something that gets lost in all the noise. The hot stock tips, the daily market drama. We're going to focus on the one thing you can actually control, your own behavior. Because as you'll see, having a solid system, well, it's way more valuable than trying to guess the next big thing. Let's get into it. So let's start with something you probably remember. Remember the absolute frenzy over the ARKK ETF? I mean, for a while there, it felt like you couldn't go anywhere online without hearing about Cathie Wood and her innovation fund. It was the talk of the town, right? Promising these incredible returns, a ticket to the future. And yeah, a lot of people jumped on board. But what happened next tells a really important story. And this right here, this chart tells the classic story of a hype cycle. I mean, look at this. The risk-on trade kicks off late 2019. Then, boom, 2020 is this massive blockbuster year where ARK just crushes it, delivering almost 5 times the S&P 500's return. But here's the kicker. By April 2021, right after it peaked, things started to go south. And the source material we looked at puts it bluntly, if you only heard about ARK after that crazy 2020 run and decided to buy in, you ended up, and I'm quoting here, in deep yogurt. Ouch. So the temptation is to ask, was ARK a bad fund? But you know what? That's actually the wrong question to ask. The real issue here wasn't the fund itself. The trap was chasing the outcome, that huge 2020 number, instead of having a solid process for knowing when to get in, and just as importantly, when to get out. This is a classic behavioral mistake, and it actually has a name. Yep, it's called resulting. And what it means is you judge how good a decision was based only on the outcome. You completely ignore the role that luck or just pure randomness might have played. The source material has this perfect analogy. It's like running a red light. If you make it through without getting into a crash, resulting is the mindset that tells you, hey, that was a good decision. But we all know it wasn't, right? You just got lucky. A bad process can have a good outcome sometimes, and man, that is a dangerous lesson to learn. And this slide really breaks it down perfectly. Think about it. You can make a really good decision, like investing in a well-thought-out diversified fund, and still have a bad outcome if the entire market decides to take a nosedive. That doesn't mean your decision was wrong. And on the flip side, you could make a terrible decision, like buying some super volatile stock based on a hot tip from your cousin, and get lucky as it shoots up. The whole point is to build a process that lets you make good decisions over and over again, no matter what short-term luck throws at you. But resulting isn't the only mental trap we fall into. Let's talk about another one, and this is through a really powerful and tragic story. The pro golfer Payne Stewart's private jet crashed because of a slow, gradual loss of cabin pressure. It happened so subtly, so quietly, that the crew probably didn't even notice they were losing oxygen until it was way too late. And financially, this is the exact same mechanism as lifestyle creep. Your income goes up, so you spend a little more on this, a little more on that. It feels harmless, but it's like a slow oxygen leak on your savings rate. And over time, it can be absolutely fatal to your financial goals. And then there's maybe the heaviest trap of all, and that's shame. It's that voice inside your head, that feeling in your gut that stops you from admitting you made a mistake. It's why people hold on to a stock that's down 80%. They just can't bring themselves to sell and lock in the loss, because that would mean admitting they were wrong. The source material calls this an emotional tax you pay on your investments, and it's so true. It just paralyzes you and stops you from doing what you know you probably should. Okay, so if we're supposed to ignore the hype, avoid that resulting trap, and fight off shame, what in the world should we be focusing on? Well, let's shift gears now from the problems to the solution. And it all builds from this one core idea. The single most powerful, most controllable factor in your financial life is your savings rate. Full stop. So this is it. This is the playbook that money masters use. It's how you can turn a scary market downturn into a massive opportunity. Step 1, save aggressively. And even better, automate it so you don't even have to think about it. You're basically buying assets when they go on sale. Step 2, rebalance systematically. This is the only way to truly buy low and sell high without trying to guess the future. It forces you to do the right thing. Third, harvest your tax losses. You turn those losses on paper into a very real asset you can use later. And fourth, you use those market drops to do Roth conversions, moving more of your shares over for a lower tax bill. See, this is what a real process looks like in action. And here is an incredibly powerful way to track your progress on this journey. It's called the Personal Freedom Index, and the question is simple. Are your annual savings greater than your annual taxes? When you can get that number to be greater than 1, you are officially investing more in yourself, in your own freedom, than you are in the government. I mean, how awesome is that for a goal to shoot for? So, when we talk about having a process, it can be pretty straightforward or a bit more adaptive. On one hand, you've got the classic buy and hold. You set your allocation, you stick with it through thick and thin, rock solid. But on the other hand, there's a more tactical approach the source calls buy and mold. Now, this is still a disciplined, rules-based system, no guessing, but it shifts between playing offense, maybe with momentum stocks in a rising market, and playing defense with low volatility stuff when the market gets choppy. The absolute key here is that neither one relies on emotion or fortune telling. They are both systems. But here's the thing, right? Following a playbook like this, it's simple. The ideas aren't that complicated, but it is definitely not easy. Actually executing on your plan when the market is in a free fall and every single headline is screaming at you to sell, 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 that's the hard part. That's where the gap between what you know you should do and what you feel like doing becomes a giant canyon. And look, this isn't just about managing your emotions during big market swings. The financial world is complicated in so many ways. Just take workplace retirement plans, for example. As one of the experts in our source material said, it's hard to dabble. You can't just be a part-time expert on this stuff. It's so complex, they say it's tough to even break into that market unless you're willing to basically starve for a couple of years to learn the ropes. And you can see why. I mean, just look at the hurdles in this one single area of finance. You've got super complex ERISA rules, demanding client presentations, a ridiculously steep learning curve, thin profit margins, and, oh yeah, the regulations are changing constantly. This is the perfect illustration of why having a dedicated process or an expert who lives and breathes this stuff is so critical. It's not something you're just going to figure out on a Saturday afternoon. And that really brings us to the true value of getting help. A great advisor, their job isn't to be some kind of stock-picking genius who can see the future. No, their real value is acting as your behavioral coach. Their number one job is to stand between you and your worst emotional instincts. It's to keep you from abandoning your own system when things get really scary. So in the end, it really all boils down to two very different paths. You have the money master. They count on themselves, on their system. They're playing an infinite game. Their focus is on the process and the signals, and they exercise emotional discipline. Then you have the money disaster. They're counting on getting lucky with high returns. They're playing a finite game, always focused on forecasts and noise, and they let their emotions run the show, rationalizing bad decisions along the way. You really have to ask yourself, which one of these sounds more like you? And that leaves us with one last and I think most important question you can ask yourself. When you look at your financial life, are you just building a portfolio, just a collection of stocks and funds? Or are you building a process, a repeatable, resilient system for making good decisions time and time again? Because honestly, the answer to that question, well, it changes everything.